Hello and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. Let's take a look at the stories for the day. The price of Brent crude oil fell by another 2% on Monday. From $124 in March, it has fallen to below $90 now. And it has been below the psychological $100 mark for almost a month. Topped with the cheap oil imports from Russia, the retail prices of fuel should have come down by now. But they haven't. Our next report explains why.
For the first time since early February, international crude benchmark Brent went below $90 a barrel last week. This level was last seen prior to Russia's invasion of Ukraine. The recent decline came amid expectations of weaker global demand and US dollar strength. Indian refiners have also been securing discounted supplies from Russia as sanctions prompted many oil importers to stop trade with Moscow. Russia rose to become India's second biggest supplier of oil. India too became Russia's second biggest oil buyer after China, although India's monthly oil imports from Russia have been declining after hitting a record in June. Only in August did Saudi Arabia overtake Russia by a thin margin to once again become the second biggest oil supplier to India after a 3-month gap. Between April to August, Russian oil accounted for about 16% of India's overall imports, compared with just a 0.5% share a year ago. Yet, Indian refiners are not passing on the cost savings derived from purchasing discounted Russian crude oil to the end users of diesel and petrol. Petrol currently costs 96.72 rupees per litre and diesel 89.62 rupees a litre in the national capital. If one excludes the impact of excise duty cuts in May, prices of petrol and diesel have been unchanged at fuel stations since April 6th for a record 166 days. Early this month, Minister for Petroleum and Natural Gas Hardeep Singh Puri had linked no revision of fuel prices to the losses that state-owned fuel retailers incurred in keeping the fuel prices unchanged when international oil prices surged to multi-year highs. Have we recouped all our losses? Puri asked. The three retailers, BPCL, HPCL and Indian Oil, posted a combined net loss of 18,480 crore rupees in the June quarter. At one point, oil marketing companies were losing 20 to 25 rupees per litre on diesel and 14 to 18 rupees a litre on petrol as international oil prices soared. These losses have been trimmed with the fall in oil prices.
If government would have allowed to increase the prices based on the crude price movement and the retail fuel prices would have adjusted accordingly, then we would have seen retail fuel prices going up substantially higher in Q1 and prior to that also. Government said that we will try to control the inflation by maybe not allowing the prices to move up. As of now, all three OMCs have reported huge losses in their Q1 performance. And this has happened despite the highest ever GRM of $16.7 per barrel. It is mainly because large losses on the marketing side. So they were not increasing the prices. That has helped India in controlling inflation to a certain extent, help the end consumers. So with refining margin declining, retail prices frozen, losses remain very high. So on the refining side, the Singapore complex refining margin had turned negative $3 per barrel. And that means they are incurring broadly on a benchmark basis. They might be incurring some losses. The overall scenario remains by and large the same. So definitely there has been some improvement as compared to Q1, but they are still not out of woods.
After Monday's fall in crude oil prices, Pokarna says OMCs are still incurring a loss of 8 rupees per litre on diesel, though this is down from 15 rupees in Q1 and 13 rupees in the ongoing Q2 up until last week. For petrol, the marketing margin turned positive yesterday to 6.5 rupees per litre. This compares to a negative 11 rupees in Q1 and a negative 3 rupees per litre until last week. Oil Minister Puri had indicated that international oil prices need to stay at $88 per barrel or below to bring some relief. Although there is no under-recovery on petrol now, for diesel it may take longer. As a prudent measure, OMCs will be allowed to recover the past losses before the benefit of any further fall in crude price can be passed on to the consumers.
Bharat Petroleum Corporation Limited is a leading oil and gas producer in India. The government has been trying to sell its stake in the Mumbai-headquartered firm for years, but the disinvestment is on hold now. The plan to privatize Pawan Hans and Central Electronics has also run into rough weather. And about 18 months after the budget announcement, there is still little progress towards the privatization of two state-owned banks. Barring Air India, the government has made little progress on the disinvestment front. But why is that so? This report offers a peek into the government's disinvestment drive and explains why it is in the slow lane.
After offloading Air India in October last year, the government has now kicked off the process to sell its stakes in its subsidiaries which were not part of the deal. Air India has 4 subsidiaries, which are Air India Airport Services Limited or AIASL, Air India Engineering Services Limited or AIESL, Alliance Air Aviation Limited and Hotel Corporation of India Limited. And the process to offload AIASL and AIESL is on. The government is also moving ahead with the privatization of IDBI Bank. DIPAM Secretary Tuhin Kanta Pandey has confirmed it this month, saying that the department would soon invite preliminary bids. The government holds a 45.48% stake in the bank, while the Life Insurance Corporation of India, which is the promoter of the bank, owns a 49.24% stake. The government will also reportedly invite financial bids for the privatization of Bharat Earth Movers Limited in the December quarter. But notwithstanding these moves, the overall picture regarding the government's disinvestment plans looks gloomy. For the current financial year, the government has budgeted to raise 65,000 crore rupees from disinvestment. But even as half of the fiscal year is over, it has raised only about 25,000 crore rupees so far. Union Finance Minister Nirmala Sitharaman had proposed the privatization of 2 public sector banks in her 2021-22 budget speech. But the amendment to the banking laws, which would have enabled the government to offload its stakes, has not been passed so far. Also, a research paper in the August issue of the Reserve Bank of India Bulletin lauded the role of PSBs. It argued that big bang PSB privatization would not be a panacea. While clarifying later, the RBI said that a gradual approach, as announced by the centre, would result in a better outcome.
Presently, today, what they're looking at is technically at IDBI Bank, which is not considered to be a public sector bank. It's considered to be a private sector bank owned primarily by the LIC. So I think there's a lot of talk, at least in the media, which one comes across about what they're going to do in terms of IDBI Bank, which is definitely a very, it's a large bank. It's doing very well right now. I think all the legacy issues have been taken care of. So to my mind, this could probably be the first experiment carried out by the government before they look at other public sector banks.
PSB privatization isn't the only area of concern. The government had planned to privatize PSUs like the Shipping Corp, Concor, Pawan Hans, BEML, Central Electronics Limited and others. In November 2019, the government put Bharat Petroleum Corporation or BPCL on the block. It had said that it would completely sell its 52.98% stake in the company. While the government received 3 tentative bids, it got only 1 financial bid from the Vedanta Group. This forced the government to shelve the plan in May 2022, pending a comprehensive review. Now, in September, Oil Minister Hardeep Singh Puri indicated that the much delayed BPCL privatization may not happen in the near future. Puri made it clear that there was no proposal whatsoever on his table for now. And earlier this year, the centre had announced the sale of Pawan Hans to a consortium. But the sale was scrapped later as questions of impropriety and non-payment of dues were raised about a company that was part of the consortium. The privatization of Central Electronics Limited may also be called off, and that of the Container Corporation of India Limited is yet to be initiated. In May, the Cabinet Committee on Economic Affairs approved the sale of the government's entire remaining stake in Hindustan Zinc Limited, or HZL. The sale of the entire 29.5% stake is estimated to fetch 38,062 crore rupees. But this sale is also yet to go through, and the government is in the process of appointing financial and legal advisors who will see it through to its conclusion. All of this has raised the question, is the government going slow on privatization?
Probably given the state of the stock markets and the volatility which is there in the market, the government may have decided to go a bit slow in terms of further disinvestments during the course of the year. I would tend to think that they would definitely be pressured in terms of meeting this target of 65,000 crores, which is definitely more reasonable than what they had earlier when they had spoken of doing the LIC disinvestment. There could definitely be some kind of shortfall in terms of overall disinvestment, which to my mind could be, means the worst case scenario may be around 20,000 crores. But this may not really affect overall fiscal balances on the whole, primarily on account of the rather good buoyancy which we have witnessed in the revenue collections, as well as the fact that our GDP is growing quite fast because of inflation, which means that the fiscal deficit ratio would be very much under control at 6.4%, even in case there is some slippage which takes place in terms of disinvestment.
The prevailing investment and economic atmosphere may have made the government go slow on privatization. But going ahead, every such decision will also have to face another headwind: the fast approaching 2024 Lok Sabha elections. Privatization has always been a politically sensitive topic, and thus there may be doubts about the government going in for any big ticket privatizations, especially of the two PSBs, during the remainder of its term.
Let us move on to markets now. Logistics stocks traded mixed on Monday after the government announced its national logistics policy over the weekend. The new policy aims to integrate and develop a technologically enabled logistics ecosystem in the country. While some analysts expect logistics stocks to reap benefits from the new policy in the medium to long term, others remain cautious on the near-term horizon. Here's our report.
On September 17, the government announced the National Logistics Policy to develop a cost-efficient and integrated logistics ecosystem for India. The government plans to reduce the cost of logistics below 10% from current 13 to 14% of the GDP in a span of 8 years. This would be in line with developed countries like the US and Germany, where logistics costs are in the range of 7% to 9%. In order to reduce these costs, the government has launched several initiatives like integration of digital system, unified logistics interface platform, ease of logistics, network planning group, and system improvement group. Not only will these measures bring several modes of logistical routes under one centralized platform, it will also abate any operational inefficiency via a digital resolution platform. While some of these policy measures may take some time to materialize, analysts believe that platforms like Unified Logistics Interface Platform and Ease of Logistics can reduce logistic costs in the medium term.
The launch of National Logistics Policy is a key step highlighting reducing the cost and improving efficiencies in the logistics sector. The move is expected to curb unscrupulous activities and organize the sector over the longer run. We believe the organized players to benefit from the government's focus on the logistics sector. Our preferred picks in the sector are TCI Express, Transport Corporation of India, Mahindra Logistics, Gati. The policy is also directionally positive for sectors such as cement and auto, among others where logistics costs are higher.
That said, analysts believe that the synergies from the new policy is already priced in.
It's a step in the right direction, as logistics as a cost of businesses will reduce from the current 30 to 14% to single digits. So, more than the logistic players, I think it would be more beneficial for the user sector, which would save on the cost of logistics. Whenever there's a revolutionary change, like what we're seeing now, being brought into a specific sector, we do see leadership change happening in the medium to long term. Since some of the existing leaders, the margins are attributable to inefficiencies in the sector, which they have been taking advantage of. Now, with efficiencies kicking in, we could see a shift of leadership to new players. This can happen across various sectors, especially we've seen that in the past happening in the BFSI space, real estate, and telecom, to name a few. So, logistics too will see a shift in leadership. Though the stocks have performed extremely well in the recent past based on the sentiments due to the expected announcement of this policy, I don't see a further immediate upside. I mean, as per my understanding, most of the stocks I think are more than fully priced at this point of time.
Meanwhile, on the bourses, shares of Aegis Logistics, All Cargo Logistics, Concur, VRL Logistics have surged in the range of 2% to 50% so far this calendar year 2022. In comparison, Nifty 50 and the S&P BSE Sensex gained 2% each during the same period. FII flows, rupee movement, crude oil prices, global cues will continue to guide domestic markets today. Globally, ECB Christine Lagarde's speech on interest rate trajectory will be tracked. The two-day US FOMC meeting also begins today.
There are several indicators to gauge the might of a country, like the size of its economy or that of its financial markets. Travel freedom enjoyed by its citizens is also one such measure which reveals a lot about a country's standing in the world. Every year, London-based immigration consultancy Henley Partners comes out with a ranking of 199 passports. It's called the Henley Passport Index. Find out more about this in our next segment.
The Henley Passport Index is a ranking of all the world's passports according to the number of destinations their holders can access without a prior visa. It is based on data from the International Air Transport Association, which maintains a large travel information database and is enhanced by Henley & Partners research team. The index includes 199 passports, giving users the most extensive and reliable information about their global access and mobility. With historical data spanning 17 years, it helps wealthy individuals and governments assess the value of citizenships around the world. The ranking is given on the total number of destinations that the holder can access visa-free. For each travel destination, if no visa is required for passport holders from a country or territory, then a score of 1 is allocated for that passport. This also applies if passport holders can obtain a visa on arrival, a visitor's permit, or an electronic travel authority upon entry. These visa types require no pre-departure government approval because of the specific visa waiver programs in place. And in case a visa is required, or where a passport holder must apply for a government-approved electronic visa before departure, a score of 0 is assigned. The same applies if they need pre-departure approval for a visa on arrival. The top 10 most powerful passports in 2022 are those issued by Japan, Singapore, South Korea, Germany, Spain, Italy, Finland, Luxembourg, Austria, and Denmark. Japan, Singapore, and South Korea have the most powerful passports. A Japanese passport provides hassle-free entry to 193 countries, one more than those from Singapore and South Korea. Russian travel documents are ranked 50th, giving easy access to 119 nations. China is placed 69th with access to 80 countries. India's passport ranked 87th with visa-free access to 60 countries. And Afghanistan's passport, ranked 112th, is the least useful, getting the holder into only 27 countries. The index historical data allows users to see how the strength of their passport has changed over the years and view the top climbers and fallers on the index.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Countries with the highest passport power are those with the highest levels of peace, Henley and Partners research has found. That's all for today. For more news and analysis, please log into our website www.business-standard.com, and we'll also be back with more. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.